Good news, everybody. The economy is growing again. All that recession talk can go away because, well, everything is just fine. Look at this economic growth. And, what? Amazon sheds $200 billion in record-breaking tech rout? And this headline comes out on the exact same day as the report of our sudden economic growth? All right, hold up. How do you explain this? How do we get 2.6% GDP growth in the third quarter, the same quarter where Amazon, the company that sells freaking everything, is getting clobbered in their earnings report? Well, as always, you have to look past the headlines, folks, and you have to get into the numbers and see where the growth and where the losses is coming from, and that paints a very clear picture of where we are in the economy right now. First things first, check this out here. Operating income at Amazon decreased to $2.5 billion in the quarter compared to $4.9 billion in the same period in 2021. Hello, that is a 49% drop in Amazon's earnings. This is not a slight miss here, folks, even though the headlines might tell you that they beat on the bottom line somehow. 49% reduction in Amazon's earnings. That is massive. And yet, when you come over here to the Bureau of Economic Analysis, you see this morning that real gross domestic product increased at an annual rate of 2.6% in the third quarter. All right, so in order to square these headlines, you have to understand how GDP is calculated. These are all the factors that go into gross domestic product, or the sum of all goods and services produced in the economy. First is the big one, personal and public consumption, i.e. consumer spending. That is the lion's share of GDP. In the United States, it's almost 70% of GDP is consumer spending. Then you have government expenditures, public and private investment, and then finally you have the trade balance, which is exports minus imports. Now, the United States has historically had a trade deficit, so this one here is a big negative number that subtracts from GDP. So somewhere in this math here is the explanation of how we got economic growth, even though all the earnings have been just god-awful. And I'm not just talking about Amazon. We've had Google, Facebook, Snapchat earnings were just god-awful. And those are advertising companies. When their earnings come down, that means nobody's spending their money on advertising. That means the economy is slowing. The bank earnings were terrible. Earnings across the board have been just god-awful. And yet we're led to believe that the economy is growing. So if you look here in the BEA's report, it does give you some clues as to where the growth came from. The increase in real GDP reflected increases in exports, consumer spending, non-residential fixed investment, federal government and state and local government spending. All right, so those were the big increases there. And we're going to focus in on the consumer spending, the government spending, and of course, the trade balance. So let's start with the easy one, the trade balance. What you're looking at here is the chart of the United States Strategic Petroleum Reserve. This is our emergency oil reservoir, and President Biden has been dumping the oil from the SPR in order to manipulate gasoline prices lower to improve his poll numbers. You can see that right here, this big drop in this blue line. That is all the oil Joe Biden has dumped from the Strategic Petroleum Reserve. He's been dumping almost 1 million barrels per day since the beginning of May of this year. That's hundreds of millions of barrels of oil at about an $85 price. Now, the biggest import here in the United States is crude oil. So all these hundreds of millions of barrels that Joe Biden has dumped from the SPR, well, that is oil that we have not had to import. And keep in mind here, imports is a negative in the GDP calculation. So a large reduction in the imports of crude oil in the United States will make the GDP go higher. And we have dumped hundreds of millions of barrels. So that is artificially inflating GDP. Another thing you need to consider is the sales of liquefied natural gas. Since Europe entered their energy crisis, we've been selling tanker after tanker full of liquefied natural gas over to Europe to help them get through the winter. And you can see that perfectly here in this chart. This is Cheniere Energy, ticker symbol LNG. This is the company that liquefies natural gas and sells it to Europe. And look at what this stock has done this year, because we're exporting billions and billions of dollars worth of natural gas. And you can see that here on this chart here. This is the United States trade balance. And you can see since about March of this year, the trade balance has been getting less negative as we've been exporting more LNG and importing less oil. That has caused a big reduction in the trade deficit here in the U.S. And remember, the trade deficit is one of the factors in GDP. So does this paint a healthy picture of the U.S. economy? No, not really, because dumping of the SPR is not something that's sustainable. We're going to have to buy that oil back and import that oil later, which means in subsequent quarters, we're going to have much bigger trade deficits. And we're going to be buying back that oil probably at a much higher price. And we may get another production cut next week as this feud between Biden and the Saudi crown prince continues to escalate. Now, another thing let's talk about is government expenditures. Those have also been going up. We've been sending a lot of military aid to Ukraine. Well, that stuff gets ordered and that stuff gets replaced. That is inflating the defense spending in the government expenditures section. We've also had things like the CHIPS Act passed recently and the Inflation Reduction Act. This is adding discretionary spending, so the government spending is on the rise. And again, that's not really indicative of a healthy U.S. economy. That's just us going further and further into debt. So not exactly a real rosy picture of the economy there either. But it's in the consumption section that you really got to watch out for, and that is what really scares me about this GDP report. First of all, I want to talk about stuff like this. These ridiculous headlines that I see on CNBC. U.S. consumer is soldiering on despite soaring inflation and recession risk, credit card giants say. Well, that's one way to look at it, that the U.S. consumer is soldiering on. But who is saying that again? Oh, credit card giants. Maybe that's your first clue that something here isn't right. And let's look over here in Barron's. Dated just today, MasterCard's earnings get a lift from travel and consumer spending. Well, MasterCard is having a good quarter. And what about just a couple of days ago? Check this one out. Visa profit surges on higher payments volume and cross-border transaction. Well, the American consumer must be doing just fine, right? Sorry, not so fast. Check out this chart here. This is consumer loans on credit cards and other revolving plans. This is America's credit card bill. Oh boy, look at that chart. Up and up we go. This is going all the way back to a few years before the unfortunate health situation in 2020, when Americans started to pay down their credit card debt because they were locked inside and there really wasn't anything to do. Plus, they got a whole bunch of stimmy checks. But right here, about the middle of 2021, as soon as they turned everybody loose, they pulled out that plastic and they went shopping again. And we have just been running up the credit cards ever since. So the problem is that American consumer who's soldiering on, he's putting it on plastic. He's going to have to pay that back. And remember those guys over at the Federal Reserve? Well, they're hiking interest rates right now. And credit card debt, that's adjustable rate debt, which means the interest on those credit cards is going up every time the Fed raises rates. So sooner or later, Americans are going to reach the limit on their credit cards, and they're going to find out that they can't afford to make the payments and that they're hopelessly in debt. So once again, this is not indicative of the health of the American consumer. This is indicative of Americans refusing to admit that their lives are getting more expensive and not making any changes to the way they live or the things that they buy. They're just putting it on the card and making the long-term problems worse. And don't think the banks have not noticed those credit cards running up, folks, because we saw that in all of the earnings reports of the major banks in this last quarter. Check this one out. JP Morgan profit drops on higher loan loss provisions as headwinds increase. JP Morgan Chase reported a 17% year-on-year drop in quarterly net income, a smaller decline than analysts had anticipated, as record income from lending helped offset the continued slowdown in investment banking and a $1.5 billion provision to cover bad credit. The banks are setting aside money just in case people don't pay them back. Again, they're looking at Americans running up the credit cards, and they're saying we better get ready for a wave of defaults, for a wave of bankruptcies, for people delinquent on their credit card debt. And folks, it is not just JP Morgan. Check this one out here. Bank of America profit drops on loan loss provisions, dated October 17th. Bank of America joined other big U.S. banks in reporting a drop in third quarter profit on Monday as it set aside funds to cover soured loans from a potential deterioration in the U.S. economy. The second largest U.S. bank added $378 million to its loan loss reserves as it braces for a weakening economy. And Wells Fargo is joining in also. Now, they had a halfway decent quarterly report and their stock did pretty well, but they did also boost loan loss reserves. There you go. The bank set aside $784 million for credit losses after reducing its provision by $1.4 billion a year ago. Now, the last thing I want to mention is a question I get a lot. Jack, is GDP adjusted for inflation? And the answer is yes, but, and it's a very big but. You see, the way they correct for inflation in the GDP numbers, they use something called personal consumption expenditures, or the PCE price index. And, well, look up here. The PCE price index increased 4.2% in the third quarter, compared with an increase of 7.3% in prior quarters. So the correction for inflation is they subtract 4.2% in order to account for inflation. To say that is insulting our intelligence would be to put it mildly. Folks, our wages have gone up by more than 4.2%, and we all know that our wages have not gone up anywhere near as much as the actual rate of inflation. The actual rate of inflation in this country, if you go by JohnWilliamsShadowStats.com, is really closer to 18% year over year. So the fact that they're subtracting 4.2% to arrive at this 2.6% growth in GDP, again, insulting just doesn't seem to cover it. They should be subtracting way more. This is just one of the many ways that the government lies to us about inflation. Remember, they're incentivized to lie to us about inflation because a lot of the government's expenses, such as Social Security and food stamps and cost of living adjustments for employees, are keyed to these inflation measures. So if they understate it, they get to keep more of the money that they collect in taxes. So long story short, folks, I can understand how the headlines would confuse the heck out of people when we see Amazon, one of the biggest companies in the world, posting these just god-awful quarters. At the same time, we have government bureaucrats congratulating themselves on economic growth. Well, if you actually look at how the GDP math is calculated, you can see it's not really such a rosy picture of the economy. We've got increases in government spending because we're sending missiles to Europe and increasing wasteful spending in Washington. We've got a big reduction in the trade deficit being caused by the dumping of the Strategic Petroleum Reserve for political reasons, so that's skewing GDP higher. And of course, the elephant in the room is the American consumer, who is putting life on the credit card right now, which in the medium term is a recipe for disaster. Sooner or later, those credit cards are going to be maxed out and those people will not be able to pay their bills. The banks can see it coming, and you can see that reflected in the earnings reports. Both Visa and MasterCard reported fantastic quarters, and the banks all setting aside money for loan loss provisions because they know American consumers will not be able to pay those credit card bills. So don't celebrate this positive GDP number just yet, folks, because we are going to be returning to negative territory real fast. Hidden in that Amazon report was this little line. The tech giant warned of weaker consumer spending in the run-up to Christmas. So the fourth quarter will not be a big positive number like we just got in the third quarter. Till next time, live small and dream big.